The headlines hit before most people finished their morning coffee: military strikes, escalation, tensions rising in regions most people couldn't locate on a map. By the time the average person processed what happened, the markets had already moved billions of dollars. I watched it unfold in real time: futures plunging, oil spiking, gold surging, defense stocks climbing, airlines collapsing, all within hours of the first reports. And I knew that most people watching the news would focus entirely on the wrong question. They'd debate whether the military action was justified. They'd argue about foreign policy. They'd take political sides and post opinions online. Meanwhile, their retirement accounts were moving. Their future purchasing power was shifting. Their economic reality was changing while they argued about things they couldn't control. I'm not here to tell you whether military action is right or wrong. That's not my expertise, and it's not what you need from me right now. What you need is understanding what happens to your money when geopolitical conflict erupts, how the shockwaves travel through the financial system, what moves where and why, and what you should consider doing about it, because whether you support or oppose any particular military action, the economic consequences affect you identically. Your 401k doesn't care about your politics. Your grocery bill doesn't care about your opinions. Inflation doesn't ask which party you voted for. Today I'm showing you exactly how war translates into money movement, the mechanisms, the chain reactions, the connections that most people never see but that determine their financial futures. This understanding won't make conflict less tragic, but it will make you less vulnerable to forces most people don't comprehend until they've already been damaged by them. Pay attention to every connection I'm about to show you. Markets respond to conflict before most people even understand what happened. The speed is almost incomprehensible to anyone who hasn't watched institutional trading during crisis. Within minutes of significant geopolitical events, capital begins moving. Not retail investors checking their phones. Institutional systems programmed to respond to certain triggers. Algorithms that process news faster than humans can read headlines. Professional traders who are awake and watching and prepared. By the time the average person learns about events through normal news channels, the first wave of movement has already occurred. The immediate reactions are largely complete before most people finish their morning routines. This creates an uneven playing field that frustrates many investors. It feels unfair that by the time you know something happened, the market has already priced in much of the expected impact. But understanding this dynamic changes how you respond. The initial moves are often overreactions. Fear drives prices further than fundamentals justify. Panic creates extremes in both directions. The sophisticated money understands this. They know that first-day movements frequently reverse partially once emotion settles and analysis replaces reaction. During recent geopolitical escalations, I watched oil prices spike dramatically within hours of news breaking. Gold surged as money sought safety. Broad stock indices fell as uncertainty overwhelmed confidence. Defense contractors gained as investors anticipated increased military spending. Airlines and travel companies collapsed as fuel costs and flight disruptions became immediate concerns. This pattern repeats with remarkable consistency. The specific percentages change, the duration varies, but the directional moves follow similar logic each time conflict emerges. Oil rises because military action in energy-producing regions threatens supply. Gold rises because fear drives capital toward assets that hold value during chaos. Stocks fall broadly because uncertainty reduces willingness to hold risk. Defense companies gain because war means contracts and spending. Travel companies suffer because oil costs rise and disruption follows. If you understand this pattern before crisis arrives, you're positioned to respond rationally rather than emotionally. You know what's likely to happen. You're not surprised. The moves that devastate unprepared investors become expected developments to those who understand the mechanics. The way professional investors think during crisis differs fundamentally from how retail investors think. Emotional response is the default human reaction. Fear triggers impulses to flee. Panic triggers irrational selling. The need for safety overwhelms analytical thinking. Most individual investors respond to crisis with emotion rather than strategy. Institutional investors have systems designed to remove emotion from decision-making. They have protocols, procedures, pre-established frameworks for responding to various scenarios. They don't decide in the moment what to do. They execute plans developed during calm periods. The focus for professional money is identifying where capital is flowing. not judging whether that flow is morally correct or logically justified, simply observing what's happening and positioning accordingly. Smart money tracks momentum shifts and reallocates quickly based on where flows are going, not where they should go. The market rewards positioning aligned with actual capital movement, not positioning aligned with what should happen according to some theory. During crisis, opportunities emerge that don't exist during calm periods. Assets become mispriced because fear overwhelms fundamentals. Quality companies get sold alongside weak ones because broad selling doesn't discriminate. Sectors with no actual exposure to conflict get dragged down because correlation increases during stress. Those who understand capital flows during crisis can position to benefit from eventual normalization. This isn't about profiting from tragedy. It's about recognizing that markets overreact and eventually correct those overreactions. The investor who bought quality stocks during the panic lows of previous crises often saw substantial gains during recoveries, not because they were callous about human suffering, because they understood that market prices and human tragedy don't need to remain permanently correlated. Understanding these dynamics provides edge that most retail investors lack. While others panic and sell at bottoms, the educated investor recognizes the pattern and responds strategically. Gold's role during geopolitical uncertainty deserves specific attention because it reveals how investors prioritize during fear. When confidence declines, capital preservation becomes the dominant goal. Growth stops mattering. Returns stop mattering. The question becomes simply, what will still have value if everything goes wrong? Gold has served this function for thousands of years, during wars, during currency collapses, during financial system failures. Gold maintained value when paper assets became worthless. This historical role creates self-reinforcing behavior during crisis. Investors expect gold to rise during uncertainty, so they buy gold during uncertainty, which causes gold to rise during uncertainty. The expectation creates the reality. Fear-driven buying pushes precious metals higher as investors seek safety they can hold. Physical gold represents something tangible when confidence in paper claims declines. The metal will exist regardless of what governments do, what companies fail, what currencies collapse. During recent geopolitical escalation, gold moved significantly within days of conflict emerging. This move was predictable, not because anyone knew the exact timing or magnitude, because the relationship between uncertainty and gold demand has remained consistent across centuries. Safety assets gain when confidence in growth declines. This relationship is structural, not coincidental. When investors stop believing growth will continue, they stop holding assets that require growth to perform. They shift toward assets that preserve value, regardless of growth. Gold doesn't produce anything. It generates no income. By growth metrics, it's inferior to productive assets. But during moments when growth seems unlikely or threatened, that lack of production doesn't matter. What matters is durability. Gold provides that when other assets cannot. Understanding this allows strategic positioning before crisis rather than reactive buying during panic. Gold exposure established during calm periods provides protection that panic buying at elevated prices cannot match. Not every stock moves in the same direction during geopolitical events. Understanding sector rotation reveals opportunities that blanket selling obscures. Defense contractors benefit directly from military activity. More conflict means more contracts, more spending, more demand for weapons, equipment, and services. The companies supplying military needs see their prospects improve when military activity increases. During recent escalations, defense stocks moved sharply higher while broad markets fell. Investors recognized that regardless of what happened to the general economy, defense spending would likely increase. That increased spending translates directly into revenue for the companies positioned to receive it. Airlines suffer through multiple channels simultaneously. Fuel costs spike as oil rises. Flight routes face disruption if conflict affects airspace. Travel demand declines as passengers avoid uncertainty. The combination pressures revenue while costs increase. This dual squeeze devastates profitability. Travel and hospitality companies face similar challenges. People don't vacation in regions experiencing conflict. They don't book international trips when uncertainty is high. They preserve capital rather than spending it on discretionary travel. Market reactions are uneven because the impacts are uneven. Treating all stocks identically during crisis leads to both excessive selling of resilient companies and insufficient selling of vulnerable ones. Understanding sector dynamics allows more precise positioning. Some sectors remain largely unaffected by geopolitical events. Domestic utilities provide essential services regardless of what happens overseas. Grocery stores sell necessities that people buy regardless of headlines. Healthcare companies treat illness that doesn't follow geopolitical schedules. This sectoral variation creates opportunity. If quality companies in unaffected sectors decline simply because broad market selling pulled everything down, those companies may be mispriced relative to their actual exposure. The educated investor recognizes this disparity and responds accordingly. Now let me explain the variable that dominates this entire framework, because everything else flows from it. Oil is the central economic pressure point during Middle Eastern conflict. Understanding why requires understanding oil's unique role in the global economy. The Middle East's strategic importance comes primarily from energy supply. The region contains massive oil reserves. More importantly, it contains critical infrastructure for transporting the oil globally. The Strait of Hormuz is perhaps the most important choke point in global commerce. This narrow waterway connects the Persian Gulf to open ocean. Roughly 20% of the world's oil passes through this strait. If traffic through the strait is disrupted or threatened, global oil supply faces immediate constraint. Threats to shipping routes increase supply risk instantaneously. Even the possibility of disruption causes traders to price in higher costs. They don't wait for actual disruption. They anticipate it. They build premium into prices to account for risk that might materialize. Supply chain disruptions drive rapid price increases because oil markets are global and interconnected. Production lost in one region cannot be immediately replaced by production elsewhere. Infrastructure takes years to build. Wells take time to develop. The supply is relatively fixed in the short term. When demand remains stable and supply is threatened, prices rise quickly. This isn't manipulation or conspiracy. It's basic economics. Fewer barrels available for the same number of buyers means each barrel commands higher price. The speed of oil price movements during geopolitical crisis often shocks observers. Prices can rise 10, 15, 20% within days of conflict emerging. These moves seem extreme until you understand that markets are pricing in potential supply losses that could persist for extended periods. Oil impacts everything else because oil is embedded in everything else. Higher crude prices raise gasoline costs directly. This is the most visible impact for most people. They see it at the pump within days of oil moving. The connection is immediate and obvious. Transportation becomes more expensive across all modes. Trucks carrying goods, ships moving containers, planes hauling cargo. Everything that moves using petroleum-based fuel costs more to move when oil rises. Shipping costs rise across industries that have nothing to do with oil directly. A furniture manufacturer doesn't produce oil, but if shipping their furniture to retailers costs more, they face higher expenses. These expenses eventually reach consumers through higher prices. Food prices increase substantially because food production and distribution is incredibly energy intensive. Growing food requires fuel for equipment. Processing food requires energy for facilities. Transporting food requires fuel for trucks, trains, and ships. Refrigerating food requires electricity often generated from fossil fuels. Every step of food's journey from farm to table involves energy costs. When oil rises, food costs rise with some delay. The connection isn't immediate like gasoline, but it's powerful. Agriculture and food distribution are among the most oil-sensitive sectors of the economy. Travel and vacation expenses increase even beyond the direct fuel costs. Airlines raise ticket prices to cover fuel surcharges. Hotels raise prices because their operating costs increased. Everything associated with travel becomes more expensive, reducing discretionary travel demand further. Oil acts as a foundational input cost across the entire economy. Almost nothing is produced, transported, or sold without some connection to petroleum-based energy. This makes oil uniquely influential. Changes in oil prices ripple through every sector, every product, every service. This is why oil-sensitive geopolitical events matter so much more than equivalent events in regions without energy significance. Conflict elsewhere is tragic but economically contained. Conflict in energy-producing regions affects everyone everywhere through the oil connection. Inflation concerns were already present before recent conflict emerged. This context makes current developments more concerning than they might otherwise be. Producer prices, the costs businesses pay for inputs, were already showing pressure before geopolitical events added additional strain. Supply chains disrupted during previous years hadn't fully normalized. Labor costs had risen. Various inputs had become more expensive. Businesses were already facing higher costs and already passing some of those increased costs to consumers. The inflationary pressure wasn't hypothetical or future, it was present and active. Higher oil intensifies this existing pressure substantially. It doesn't create a new inflationary episode, it worsens an inflationary episode already underway. Energy shocks can reverse progress on price stability that took years to achieve. Central banks had been working to bring inflation down from elevated levels. Progress was being made. Inflation was declining from peaks, though not yet reaching targets. Conflict-driven oil spikes threaten that progress directly. If energy costs surge and sustain elevated levels, the inflation measures that had been improving start deteriorating again. The progress reverses. This creates a particularly difficult environment for policymakers. They face inflation that was already proving stubborn now receiving additional upward pressure from factors entirely outside their control. No domestic policy can stabilize Middle Eastern conflict. No interest rate decision can prevent oil supply disruption. The Federal Reserve's role becomes crucial and constrained simultaneously. The US central bank influences the economy primarily through interest rates. Higher rates slow borrowing and spending, which reduces inflationary pressure but also slows growth. Lower rates stimulate borrowing and spending, which accelerates growth but can increase inflation. Rate cuts are difficult to justify when inflation remains elevated. Cutting rates would add stimulus to an economy still experiencing above-target inflation. This risks making inflation worse, potentially much worse, but pressure for rate cuts often increases during uncertainty. Economic weakness during conflict makes lower rates seem appealing. Markets struggling make stimulative policy seem necessary. The temptation to cut rates increases even when the inflation math argues against cutting. Monetary policy becomes constrained during inflation spikes caused by supply factors like oil. The Fed can't produce more oil by adjusting interest rates. The inflation coming from energy costs isn't caused by too much demand that rate hikes could cool. It's caused by too little supply that monetary policy cannot fix. War-driven energy inflation complicates policy decisions enormously. Do you tighten policy to fight inflation even though you didn't cause it and can't fix its source? Do you loosen policy to support growth even though you'll worsen inflation you're supposed to control? There's no good answer. Only trade-offs between bad options. This is the position central banks face during energy-driven inflationary episodes. Leadership transition at the Federal Reserve adds another layer of uncertainty during already uncertain times. Central bank leadership influences monetary policy direction significantly. Different chairs bring different philosophies, different risk tolerances, different interpretations of the Fed's mandate. Transitions create periods where future policy direction becomes less predictable. Presidential appointments shape who leads the Fed. The administration's preferences influence who gets nominated. Political considerations affect confirmation processes. The central bank's supposed independence exists within political reality. Political pressure for lower interest rates often intensifies during economic stress. Lower rates appear to help in the short term. They make borrowing cheaper. They boost asset prices. They create short-term economic improvements that political timelines favor. The tension between inflation control and rate reduction goals becomes acute during transitions. The incoming leadership may face pressure to cut rates that outgoing leadership was resisting. The shift can change policy direction even if underlying conditions haven't changed. Markets try to anticipate these shifts. Expectations about future Fed leadership influence current asset prices because investors position based on expected future policy. Uncertainty about leadership adds uncertainty about policy, which adds uncertainty about asset values. The complexity multiplies. Geopolitical conflict creating inflation pressure, central bank transition creating policy uncertainty, markets trying to price in unknown future decisions during periods of elevated stress. Let me explain the dilemma that monetary policymakers face more precisely because it affects everyone's financial life. Lower interest rates stimulate borrowing and spending. This is their purpose. Cheaper money encourages taking on debt. More debt finances more purchases. More purchases drive more economic activity. But stimulus can increase inflation if supply is constrained. If people have more money to spend but there aren't more goods available to buy, prices rise. The additional spending chases the same quantity of goods, bidding prices higher. This is precisely the risk during supply-constrained inflationary periods. Cutting rates adds demand to an economy where supply is already insufficient. The additional demand worsens the inflation that was already problematic. Housing markets are particularly sensitive to mortgage rates. Even small changes in mortgage rates significantly affect monthly payments on large home purchases. Rate reductions can quickly stimulate housing demand, which pushes home prices higher, which feeds back into inflation measures. Reigniting asset price inflation while consumer price inflation remains elevated creates the worst possible combination. People face higher costs for necessities while housing becomes even more unaffordable. Neither condition improves and both potentially worsen. The Policy Balancing Act becomes nearly impossible with energy shocks adding pressure. The traditional tools don't address the problem's source. Using them anyway risks making other problems worse. This isn't just academic discussion. It affects your mortgage rate, your car loan rate, your credit card rate, your ability to borrow and at what cost. Mortgage rates are tied to monetary policy indirectly but significantly. When the Fed influences short-term rates, longer-term rates that affect mortgages also respond. When uncertainty about policy direction increases, rate volatility increases. When inflation expectations rise, rates tend to rise regardless of Fed action. Car loans and credit card rates face similar influences. The cost of borrowing across all forms responds to the broader interest rate environment. When that environment becomes uncertain and inflationary, borrowing costs tend to rise or remain elevated. Household financial strain increases when rates remain elevated during periods when incomes aren't rising correspondingly. Debt service costs consume more income, less remains for other spending. Financial stress increases. This is how geopolitical events thousands of miles away eventually affect your household budget. The connections aren't obvious, but they're direct. Oil rises, costs rise, inflation rises or persists, rates stay elevated or increase. Your borrowing costs more. Your purchasing power declines. Some discussion of a longer-term energy strategy provides context for why immediate relief is unlikely. Expanding oil production from sources outside conflict zones takes time. Existing production can't be increased dramatically overnight. New production requires drilling wells, building infrastructure, establishing transportation capacity. Years of work. Structural production limitations prevent immediate supply responses. Even countries with vast reserves can't turn those reserves into delivered oil quickly. The capacity to produce and transport oil develops slowly. Energy strategy operates on long timelines. Decisions made today about exploration and development produce results years from now. The supply available today reflects decisions made years ago. Current conflict creates immediate effects that current policy cannot immediately address. This mismatch between immediate impact and delayed response extends the duration of energy shocks. Oil prices can remain elevated for extended periods because new supply takes extended periods to develop. Global capital flows add another dimension to how conflict affects markets. Concerns about US economic stability during conflict can reduce foreign demand for American assets. International investors who might otherwise buy US stocks or bonds may hesitate or redirect capital elsewhere during uncertain periods. Global investors have been diversifying away from concentrated US exposure for various reasons. Geopolitical uncertainty accelerates this tendency. Capital that might have flowed into US markets instead flows elsewhere or stays on the sidelines. Reduced foreign demand can pressure stock valuations directly. Stock prices reflect supply and demand like any market. Fewer buyers mean less upward pressure on prices. When international capital that had been flowing into US markets slows or reverses, prices face headwinds. The dollar's reserve currency status provides some insulation but doesn't eliminate these dynamics. The dollar remains central to global commerce and finance. But that centrality doesn't mean unlimited demand for dollar-denominated assets regardless of circumstances. Currency movements add complexity. Dollar strength or weakness affects international competitiveness, foreign earnings translation, and capital flow incentives. Geopolitical events can trigger currency movements that create additional effects throughout the financial system. Stock prices depend on buyer demand regardless of the underlying company's fundamentals. This point deserves emphasis because many investors don't fully appreciate it. A company can be growing earnings, maintaining strong competitive position, and executing well. But if buyers don't materialize for its stock, the price doesn't rise. Valuations require continuous capital inflows to sustain and increase. Without new money entering markets, Prices stagnate or decline even if nothing fundamental changed. Markets need buyers to go up. Fewer buyers equals reduced upward pressure. When geopolitical uncertainty reduces risk appetite, when international capital redirects elsewhere, when domestic investors prioritize safety over growth, buyer demand decreases, prices respond accordingly. Capital migration impacts market momentum substantially. During periods when money is flowing into equities, prices rise easily. During periods when money is flowing out, prices fall easily. The same fundamental news produces different price responses depending on the capital flow environment. This is why market behavior during geopolitical stress often seems disconnected from individual company performance. The macro capital flow overwhelms the micro company fundamentals. Everything rises or falls together regardless of specific circumstances because the broad flow dominates. Your retirement accounts are directly exposed to these dynamics. 401k accounts are heavily tied to US equities for most participants. The default allocations, the target date funds, the common choices, these concentrate exposure in US stocks. Stock market volatility directly affects retirement savings. The account values people check periodically reflect market prices that respond to all the factors I've described. Geopolitical events move those prices. Your retirement balance moves accordingly. The connection between world events and retirement security is direct even though it feels abstract. Conflict in distant regions affects oil. Oil affects inflation. Inflation affects monetary policy. Policy affects interest rates. Rates affect stock valuations. Stock valuations affect your retirement account. Long-term wealth accumulation depends on navigating these connections over decades. The person who panics and sells during crisis locks in losses. The person who understands the dynamics and maintains appropriate allocation benefits from eventual recovery. The difference in outcomes over a career can be hundreds of thousands of dollars. Let me crystallize the domino effect framework because understanding the full chain clarifies everything. Conflict threatens oil supply or triggers concern about supply. This is the initial event. Oil prices spike reflecting actual or anticipated supply constraints. This is the first domino. Higher oil costs spread through the economy, increasing costs for everything transported, produced, or distributed using energy. Second domino. Inflation rises or persists longer than it would have otherwise. Third domino. Central bank options become constrained. Cutting rates risks worsening inflation. Raising rates during already stressful periods risks recession. Fourth domino. Interest rates remain elevated, or uncertainty about future rates increases. Fifth domino. Market volatility increases as investors reprice assets under uncertain conditions. Sixth domino. Retirement accounts and personal wealth fluctuate, reflecting market moves. Seventh domino. Everything connects. The person who sees only headlines about military action misses the chain reaction flowing toward their personal financial life. The person who understands the connections can anticipate, prepare, and respond strategically. Uncertainty itself becomes a dominant market force regardless of specific developments. Markets dislike uncertainty more than they dislike bad news. Confirmed negative developments can be priced and processed. Unknown future developments cannot be precisely valued. This unknown quality itself becomes a weight on asset prices. Unknown duration of conflict creates sustained uncertainty. Will it escalate or de-escalate? Will it spread or remain contained? How long will disruption continue? When will normal conditions return? Each unknown prevents confident valuation. Investors require larger margins of safety when outcomes span wider ranges. They pay less for assets whose future value is harder to predict. Unknown economic spillover creates additional uncertainty. Which industries face most exposure? Which companies will adapt successfully? What secondary effects will emerge over time? Volatility increases during unclear geopolitical environments because price discovery becomes more difficult. Each new piece of information creates larger moves because uncertainty amplifies the significance of any new data. This elevated volatility persists until clarity emerges. Either the situation resolves and normal conditions return, or the new situation becomes accepted and predictable. Volatility declines when outcomes become more certain, regardless of whether those outcomes are positive or negative. Financial education provides the protection that prediction cannot. Nobody knows exactly what will happen. Nobody knows precise timing, magnitude, or duration of market moves. Anyone claiming certainty about complex geopolitical and economic outcomes is lying or deluded. But understanding the mechanisms provides advantage even without prediction. You know the general patterns, you know the logical connections, you know what responses make sense given different scenarios. Understanding economic linkages reduces fear. The unknown creates anxiety. Understanding doesn't eliminate uncertainty but makes it comprehensible. Comprehensible uncertainty is easier to manage than mysterious chaos. Knowledge allows strategic positioning. You can adjust allocation before crisis. You can prepare responses in advance. You can avoid emotional reactions because you anticipated developments intellectually. Individuals must take responsibility for financial awareness because no one else will protect you adequately. Not financial advisors who profit from your activity. Not media that profits from your attention. Not politicians who profit from your votes. Only you bear the consequences of your financial outcomes, so only you are properly motivated to ensure your preparation. Preparation matters more than prediction. You can't know what will happen. You can know what you'll do given different scenarios. You can ensure your allocation is appropriate for various outcomes. You can build resilience that doesn't depend on any single forecast being correct. Economic change creates opportunity for those prepared to recognize and act on it. The dislocations created during market stress open possibilities that don't exist during calm periods. Assets become mispriced. Inefficiencies emerge. Relationships that normally hold break temporarily. Research-driven investing becomes more valuable when markets are dislocated. The edges available during calm periods are small and competed away. The edges available during stress periods are larger because fewer investors are thinking clearly. Positioning for macroeconomic shifts can produce substantial returns if the analysis is correct and the timing is reasonable. The investor who understood the oil inflation rate connection before recent events could have positioned accordingly. That positioning would have produced results. Education provides the foundation for recognizing these opportunities. Without understanding the connections, opportunities look like random price moves. With understanding, they look like logical responses to changed conditions. Let me bring this together with the overarching framework you need. Geopolitical conflict transmits through energy markets into inflation, into central bank policy, into capital flows, and ultimately into personal wealth. This transmission is not theory. It's observable repeatedly throughout financial history. Every significant conflict in energy-producing regions has followed similar patterns. The specific numbers change. The underlying dynamics don't. War's not just a political event, it's an economic shockwave traveling through every layer of the financial system and eventually reaching everyday life. Your grocery bill, your gas tank, your mortgage rate, your retirement account, all connected to events that seem distant and abstract. This understanding doesn't make conflict less concerning, it makes your response to conflict more intelligent. The person who understands reacts strategically, adjusts positioning thoughtfully, avoids panic selling at bottoms, maintains appropriate allocation through volatility, eventually benefits from recovery while others remain damaged. The person who doesn't understand reacts emotionally, sells when afraid, buys when confident, systematically underperforms because emotions guide decisions that analysis should guide. The information I've shared today provides framework for the first response, not complete investment strategy, not specific recommendations, framework for understanding how the pieces connect. From this framework, better decisions follow. Not perfect decisions, better decisions. And better decisions compounded over decades produce substantially better outcomes than emotional decisions, however well-intentioned. Write in the comments how you're thinking about positioning given current uncertainty. What connections had you not considered before? Sometimes articulating your analysis clarifies your thinking. Share this with someone watching news headlines without understanding the financial connections. They may not realize how distant events affect their personal economic situation. The understanding might change how they respond. The world will continue generating uncertainty. Conflicts will emerge. Markets will respond. The connections I've described will activate repeatedly throughout your investing lifetime. Being prepared doesn't mean having perfect forecasts. It means understanding the mechanisms well enough to respond intelligently regardless of specific developments. The dominoes will fall in sequences you can anticipate even if you can't predict which events trigger them. Understand the sequence. Position for resilience. Respond with strategy rather than emotion. That's how you protect your money when war shakes markets. That's how you turn others' panic into your opportunity. That's how you build wealth that survives whatever the world delivers.